All right, today we are going to talk about pay-to-play provisions. Now, if you're not familiar with these, they're not super well known, and frankly, not a lot of people talk about them because usually when a pay-to-play provision occurs in venture capital, it's not really a good thing. But every time that you see a company that has a bunch of layoffs, you can kind of tell that they're struggling. There is a decently high chance that there is a pay-to-play provision in their future. Let's talk about what a pay-to-play provision actually is. Pay-to-play provision basically is a tool that investors can use to encourage other investors to help support a company. This is how it generally works. Let's say that you've got a company and they need $5 million because if they don't get that $5 million, they're probably going to go out of business, right? But your anchor investors, they only want to put in $2 million. To understand pay-to-play provisions, you also need to know what pro rata is. A pro rata right, simply put, is what's your ownership of the company and your corresponding obligation or opportunity based on that ownership. So for example, oftentimes you see pro rata rights, which is simply a right to invest in the company to maintain your ownership level. And so, for example, if I've got a $10 million company valuation and I own 10% of that company and they decide that they are going to raise an additional $5 million into the company, well, that's going to dilute my ownership. And so a pro rata right essentially allows me to invest $500,000 in that round and allow me to maintain my ownership percentage, because that would give us a $15 million valuation on the back end, and I would continue to own 10%. So those are the basics of pro rata rights. That's important because in a pay-to-play scenario, oftentimes what happens is, let's say the company needs to raise money and they are going through a really tough time. So other investors that aren't investors in the company already aren't willing to invest. And the insiders are looking at it and saying, hey, we think that there's an opportunity here for this company to make it to that milestone, but they just need a little bit more capital, right? Imagine that you are in a boat as a startup and you're rowing and you make it halfway across the lake and you lose your paddle. So you are in a tough spot because you need to make it through the rest of the way. And so you ask your investors if they'll lend you a paddle. Now, your investors in that case are in a really strong situation because you're kind of stuck in the middle of the lake, right? This happens to startups quite a bit, right? They raise money and something happens, right? Lots of things can happen in startup land. It's a very risky place, and they don't quite make it to that milestone that allows them to raise more money from other investors, and they're in a tough spot. Well, some of your investors may want to encourage all the other investors that are also in your deal to pony up money, because it's not really fair for them to kick in the money to buy you the ore, to get you across the lake, and then everybody benefits in the upside from that. And so what they'll do is they'll put in place what's called a pay-to-play provision. Now, in the pay-to-play provision, they will essentially require that all investors pony up an investment relative to their ownership in the company. Let's say the company needs $5 million, and the investors as a whole represent 60% of the ownership. And of this 60% of the ownership, let's say the lead investors own about 50% of that. So essentially 30% of the business is owned by your lead investors. They'll then kick in half of this $5 million. So they're going to put in $2.5 million. Well, the other 50% of this 60% ownership needs to come from the other inside investors. And so to encourage them to do that, they'll have this pay-to-play provision that basically says, if you don't invest and you force us to have to kick in additional money to cover your spot, then what we're going to do is we're going to take your investment, we're going to convert it from preferred shares to common shares. And typically what they'll do on top of that is they'll also do a reverse stock split. So a very common one is 10-1. So we're going to take 10 of your preferred shares and we're going to convert them into one common share. That effectively wipes out a lot of investors, because if you own 10% of the company, you're going to end up owning 1% of the company if you don't participate in this. And if that 10% cost you $1 million, now your stake is only worth 100K. So it can be very punitive. In fact, it can get even worse. In some cases, I've seen pay-to-play provisions where it's 50-1. It basically just completely wipes you off the cap table. Now, the other big thing is you get converted from preferred to common. That's important because preferred shares typically come with a lot of different rights. They could come with pro rata rights, that ability to keep investing to maintain your ownership in the future. They come with information rights, so the ability to know what's going on within the company. Most importantly, probably, they come with liquidation preference rights. Now, liquidation preference basically provides downside protection in the event that a company goes under. What it basically says is that preferred shareholders will get paid back their investment amount before common shareholders get paid back. And this is important because let's say a company has raised $10 million and the company sells for $9 million. Well, in that case, even if preferred shares don't own the entire company, they're going to get paid the entire $9 million and common shares will get nothing. And when a company is really struggling and they have to put in place a pay-to-play provision, the likelihood of them being in that scenario where they end up selling for less money than they've raised in total is very likely. And if you get wiped to common, you effectively lose all of your downside protection. So in that case, it's not even so bad that like you get reduced down to 100K. It gets worse because your likelihood of even getting that 100K becomes a lot less likely. So why do these pay-to-play provisions get put in place? Well, as you can probably tell, they get put in place when a company is not doing particularly well and they need help. And that's ultimately why I wanted to talk about them right now, because we're going to see a lot of pay-to-play provisions popping up, I believe, over the next 12 months. As we head into a recession and as capital becomes more scarce, what you're going to see is companies are going to really struggle to raise additional capital to continue funneling growth. And they're going to have to go back to their inside investors. And their large inside investors are probably not going to want to pony up lots of cash into these businesses. Most of these investors are going to be trying to conserve cash as much as they can because they'll have many different portfolio companies that they need to support. And so they'll be doing things to encourage other investors who also have the same mentality of like, I'm going to deploy as little capital into my current startups as I have to, so that I have as much cash as possible for follow-on needs, especially for these pay-to-play provisions where they have to pony up money to protect their investment. And so that dynamic becomes kind of this vicious cycle where because nobody really wants to pony up money right now, there's going to be more incentive to put in place these pay-to-play provisions to force everybody to put money in. The other thing is that I think the really smart entrepreneurs have already made a lot of cuts to their business and already went out and raised money from their investors to give them runway for the next couple years. But they did so at a sacrifice to valuation, which they were willing to do because they understood that now is a pivotal time to make sure they had that runway. There have been a lot of other entrepreneurs that have said, hey, I don't want to take a hit on valuation, or we've grown so much, we deserve to be a much higher valued company. And I'm just going to wait until the markets recover. I worry that markets aren't going to fully recover and they're going to be in a tough spot where they're going to need more money in the future, which is why I think you're going to see more and more pay-to-play provisions pop up over the next 6 to 12 months as these companies run out of money and have to go back to their investors and say, hey, you guys got to pony up more, we're going to go out of business and you're going to lose your entire investment. And that's in turn going to encourage those investors to put these provisions in place to encourage the rest of investors to put in the money necessary to get the company the runway they need. And ultimately, it could end up being very damaging to investors and to entrepreneurs when these provisions get put into place. From my experience, pay-to-play provisions are tough because when they get pulled out, it really means that the company is in a tough spot. And it's pretty unlikely that the company is going to be able to turn things around and have a massive outcome. And that always begs the question, as an investor, of whether or not you should put more money in under a pay-to-play scenario. Because even if it's a relatively small amount, it could be just, more money going after bad. In some cases, it makes total sense to not participate in the pay-to-play, to let your shares and your prior investment get converted from preferred to common and then split from 10 to 1 or 50 to 1 or whatever it might be. Because at the end of the day, sunk costs are sunk. You made that investment. It really doesn't have any future impact on your dollars today. And so there is a logical and reasonable argument to be made that, hey, if you believe that the company can't turn things around, then you really shouldn't put any more dollars in. All right, so that was a lot. I hope that was helpful in terms of understanding what a pay-to-play provision is and getting some inside baseball into topics that typically aren't talked about in venture capital. If you've enjoyed this video, check out some of our other ones, like when will valuations get back to their 2021 levels, which, secret, they probably won't. Thanks.